Hello everyone, welcome to my channel Sujit Patra Ekdam Real Estates. So there are many investment vehicles in the market which gives good returns as well as high return also. But there are two common investment vehicles, that is investment in the real estate and investment in the shares or stocks. These two investment vehicles mostly find in the investment bucket of a persons or individual or organization or corporates. But while investing in these two vehicles, that is real estate and stock market, we have to adopt much more prudence and due diligence we have to do. Without proper due diligence, if we invest, then we will not get good returns. And this real estate or stocks, it always depends upon the time of investments. That is the most important factors of investments. So we'll discuss about real estate investment versus stock market investment. So we'll discuss basic features about this real estate and stock market. What are the difference? So the basic features of this stock as well as real estate. While investing in the stocks, we get the shares in the earnings of a company. Similarly, in real estate, when we invest, we get a piece of land utilized for our further expansions. And if we see the ownership part, the stock side, they are basically the owners on a piece of paper, but technically they cannot own the company. They are the owners on the papers only, on the document, but they are not the actual owners. But on the side of real estates, you can be a complete owner of the property. It is on the paper as well as complete owner of the property. And if you see the liquidity part, here the stock is highly liquid. It can be liquid at any point of time, but for real estates, it is a less liquid in comparison and can take time depending on a case to case basis. But if the market is good, location is good, the time factor may be less, but compared to stocks, it will take more time. And maintenance factor, on stocks, there is no maintenance charges to be paid. But in the real estate, if you are a owner, then also you have to maintain the property thoroughly, and you have given out on rent also. There also you have to maintain it thoroughly, and you have to incur a maintenance charges on periodical basis to keep it in a good conditions. Similarly, on risk level, generally stocks are very volatile. It depends on many conditions like economic conditions, political conditions, and many ups and downs in the market. There are many factors due to which the stocks are very volatile. But real estate, on the other hand, is relatively stable. So, what are the pros and cons of real estate investments? We'll invest in the real estates, but if we see the plus side or the pros sides, there are many positive factors involved in the real estate. The first is it is easy to understand. It is not a rocket science at all. It can be easily understand, only that market and the location. These two factors, if you understand, then it is easy to understand also, as well as investing with debt is secure. That means we can avail a finance by investing 15%, 20%, and the rest of the amount we can take finance. So that means by investing 20%, we will be a owner in a property by availing loans or finance. Similarly, hedge against the inflation. Generally, the real estate grows along with the inflation. It goes along with the inflation, and it also gives a tax advantages. Like the government, actually, they gave lot of tax advantages uh, for availing home loans. So these are the advantages. If we see the other side, the minus side or the con side, it requires more maintenance. We have to incur more maintenance charges to keep the property in a good conditions, and it is expensive and highly illiquid, because investment in real estate is requires a lot of uh, money and funds, and it generally easily got liquidated, and it is highly illiquid also. Similarly, this it in involves also high transaction cost. If you want to go for a selling of the property, there are a lot of stamp duty also involves, and for every transactions it requires a high transaction cost. Stamp duty and registration cost are also high, and it is difficult to diversify. Suppose if you purchase in a particular location, and if you want to shift to other location, it cannot be shifted. And sometimes also it happens the real estate in a particular location grows high, and in other location it does not grow high. So it is difficult to diversify also, and returns always are not sure. Due to the global meltdown also, we have seen in 2008 also, returns are not sure in the real estate sector also. And if you see the stock sides, similarly also there are plus and minus also. On the plus side, on the positive sides, definitely the stocks are highly liquid. By pressing a button, you can purchase stocks, you can sell the stocks also. So on the click of the mouse, you can sell and purchase the stocks. So it is highly liquid also, and it diversified portfolio of investment. You can invest in any of the sectors as you like. Either you invest in real estates, or in pharmaceuticals, or in finance and banking sectors. In any of the portfolio or in any of the segment, any of the sectors, you can invest through stocks. So you can keep a good diversification of portfolio. Similarly, here now by opening one demat account, you can invest in the stocks also, but it involves a lesser transaction cost compared to real estate. And in the other side, that is on the negative sides, here it is more volatile. Compared to real estates, it is more volatile depending upon the political condition, or any news came in the market, or global conditions, or any economic conditions. So these are all conditions due to which the stocks are very much volatile, and it involves a capital gains. Suppose when if you want to sell a particular stocks with a gain, then it incurs a capital gains. We have to pay the capital gain tax, and as well as also on the dividend also we have to pay taxes. And it always trigger a emotional decision making. On the emotion side, we make lot of buying decision as well as selling decision on stocks. So it is a emotional decision making. And if you see the investment, so generally investment over a period of time, that means what we have invested and what is the market value, we can see our returns. It is the general thumb rule. After a certain period, suppose after 5 years, after 10 years, suppose we want to know what is the return on my investments. So that is a very simple funda or the calculation. That means the current value, the market value, and the less, that is the cost of investment, that is the profit divided with the cost of investments into percentage. So we'll get the returns. But actually this is not the correct way to get the returns. So we have to see the other factor, that is the CAGR. CAGR is the correct method of getting the return part on any investments. So CAGR is compound annualized growth rate. So it is the mean annual growth rate of an investments over a period of time. We get the CAGR and it denotes a mean growth rate over a period of time what we have invested. So generally the CAGR is calculated by the present value of investment and the future value of investments and the number of years. So this is the formula. That means the future value divided by the present value what we have invested upon 1 by n. N stands for number of years minus 1. So in this way the CAGR is determined, and by CAGR we get the our rate of return on a investments, whether it is real estates or stocks. So how will calculate on the real estates? In return on real estates. But generally this real estate investments are depend upon the market to market condition, and these are all very localized. So in a particular city also different location gives you different return also. So we have to see all other factors, where it is going, what the infrastructures are coming. So suppose if we have taken a example of BKC area, that means Bandra Kurla complex of Mumbai area, and we have considered the residential segment only. So that means here the initial investment is 38 lakhs over a period of 5 years, and the current value is 4.43. So we have invested 3.80 CRs and the current value is 4.43 CRs. So here the return is 3.13% over a period of 5 years. By considering the selling rate 38,000 in the year December 17 and the current selling rate, that is 44,000 in December 22, with the assumption that we have purchased a flat of 1000 square feet. So on the real estate, the CAGR, by taking an example of BKC in Mumbai, the rate of return for over a period of 5 years comes to 3%. But if we see the CAGR on stock market, the formula remains the same, only the Sensex we have to see. So Sensex in December 2017 it was 34056, and in December 2022 it was 60840 over a period of 5 years. So here the rate of return is 12.3%. So here actually we have not considered the dividend also. So this is the Sensex value we have considered. So on the basis of the Sensex value, the CAGR is coming 5%, but it also depends the stocks which you are purchasing or which you are holding and which sectors you are investing. So the takeaway is always it depends on the financial situations. What is the financial situation of the investors and whether what their risk tolerance level, whether they are able to take the risk or they are able to hold the risk, and what is their goal. The goal is whether it is for a short term goal or a long term goals, and their investment styles, how they are investing, in which time they are investing, whether they are investing in the bull's time or in the bear's time, or when the real estate market is down, that time they are investing, or when the real estate market is up, that time they are investing. So all the times the investment style and the period of investment is most important, but the final wording or the takeaway will be to have a better portfolio with a good return. Always it is advisable a combination of real estates and stocks. So we have discussed lot of things about investments on real estate as well as stocks. Hope you have liked my video. If you have liked my video, please consider for like, share and subscribe. Thanks for watching.